Welcome, everyone, to Name Confidential Live.
Welcome, everybody, to Name Confidential Season 2, Episode number 11. I'm your host, Ben Fox, and today I have the pleasure of introducing our speaker, Greg Corneille. Greg is a CPA and wealth advisor for Choice Wealth Management and also a proud member of the NAIM board. So, Greg, how are you doing?
Doing good. How about yourself?
Good. I don't know if you realize, because there's a lot going on in the market, but it's Pi Day Friday today.
Yep.
Yeah,
Yep.
so always get the fun episodes. I feel like I looked at that, I'm like, oh no way, I get that
Yeah,
wrong.
I got to look and see, but I think the local farmers market, the pie vendors will come and do their thing. So I gotta look and see where the nearest farmers market is, so I can get some pie. So
Definitely. Oh
yeah,
yeah, I just thought of that too. I like looked right before we got on here. I'm like, oh, that's right. I gotta check that out.
yeah.
Well, it's been a busy week, and we'll hop into that. But first, I like to always start off with the name exposure index. So let me share my screen here. All right. And then it's showing up.
Yeah, I can see the screen.
Perfect. All right, so just a reminder for everybody, the name exposure index represents the average exposure to U.S. equity markets reported by our members. We go over this each and every week, and it looks like we had a little bit of a dip from last week to this week from 74.96 to 68.80. I'm not necessarily surprised to see a little bit of a dip, just seeing with everything going on in the market. How about yourself?
No, I hadn't seen this week's number, but I was surprised it was as high as it was last week. And I'll tell you, and I remember telling Asher this when I talked with him. My The one thing about the exposure index you have to keep in mind is that there are some managers who utilize leverage and some who don't. Um, and so, like for me and for our strategies, like we're either leveraged or we're not, right? So we don't have any strategies that might use single beta funds at one point and then go up to 2x funds. So that's where it can be kind of dicey. And I think if if we were, this is just my guess, if we just asked for the exposure to equities, not taking into account leverage, then that number would be lower. I mean, I'm certainly, it would be lower.
Oh, definitely. I know that there are a few, including Scarecrow over here, that we use leverage. So we're going to be pushing that number up, submitting 200 when we're very bullish on the market.
Well, I mean, but let me ask you, I mean, would you ever be fully invested in a single beta?
At Scarecrow, no, because everything that we
Okay.
do is with a leverage mutual fund.
Right. So that's my point. I mean, like you being, 50, you having 50% exposure to equities is going to look like a single beta, but that's different than, if I have a strategy, if I have a strategy that does not use leverage and we're fully invested. So in terms of reporting to the to the exposure index, they're going to say the same thing.
Mhm. Yeah, it would be interesting to see the difference if we dial that back to what you're saying. So it's a
Yeah.
little bit more consistent. Hmm.
So yeah, just I mean, I don't. Maybe it's something we should talk. I'd be interested to see, how it breaks down as far as folks who use leverage and folks who don't. But yeah, that number would certainly be lower.
Sounds like something to investigate on the side.
Yeah.
The Greg version of the name exposure index. Well, perfect. Well, we can hop right into it. It's been a very crazy week, still a lot of fear in the market. What are you seeing on your end? I'm gonna unshare my screen here too.
Sure. So I'll start, and I guess if I can share my screen, I'll start with all right, let's see here. So couple things. Um, Okay, you can see my screen now?
Loading for me still. No, I can see it.
Okay. So a couple things. Earlier this week in the NAAIM Facebook group, somebody brought up there was a white paper that I think it was from 2023, an award-winning NAAIM white paper. And I believe the title was something like The Canary in the Coal Mine. And the idea, oh gosh, I thought I had it pulled up, the specific criteria. Um, but I believe it was the S&P 500 declining from from a recent high, 5% or more inside of 15 days, and two closes below the 200-day moving average. So that's what we have right here. Whoops. So this was what, Tuesday? Um, yeah.
Yeah,
So
because Monday was very volatile, so that should be Tuesday.
yeah, so that's what, 14 trading days, and there's your second close below the 200 days. So the point, and I'm very generally paraphrasing here, is that signals that more that more pain is ahead. So I thought that was interesting. I kind of look at kind of a similar metric. Well, one that kind of ties into, our overall momentum score, what I kind of use as in terms of like overall momentum. So one thing I look at is the 5-day rate of change. I look at a 5-day rate of change of 5% or below. We did not see that in this drawdown right here. So that's, I guess you can say that's kind of a good thing, because you will typically see that at the onset of a significant market decline. That's, kind of how I would look at a spike in volatility. But the other thing that I have, and where you see this arrow in the chart here, let me see the best way I can explain it. Actually, let me switch gears. I'm going to stop sharing for a minute, and I'm going to share. Okay, I'm not sure how to share a tab.
Oh, just a single tab that you have?
Yeah. Oh, okay. I'll just switch the screen here. I apologize. Um, okay. All right. So, I apologize for that delay. So this is kind of what I look at, and I'll kind of explain what's going on here. Um, I use something called that I'll kind of call like total momentum. Um, Basically, what it is the 125 and 250-day trailing momentum. And when I say momentum, basically the average change in price between the most recent close and the last either 125 or 250 trading days, right? So we look at those two numbers. We also look at the 5-day rate of change that I mentioned earlier. And then the last thing included in that is the total drawdown over the past year, right? And so, okay, so this first column is the is that total momentum score. So when that falls below 20%, that's kind of the first red flag that I look for. Okay. So going back to 1990, this has happened 15 times. So 15 times over the past 34 years. 16, I guess, if you include this week, because it happened this week. So 16 times over the last 34, 35 years. 10 of the, obviously we don't know what's going to happen, from here, but in 10 of those 16 instances, the decline got worse. 8 times the decline formed into a bear market or something close to it. We talked about the fact that, a bear market is defined as a decline of 20% or more, but we've had several other instances where the decline has reached somewhere in the range of 18 to 19%. So those weren't technically bear markets, but they kind of felt like it. So, so in this column, that is that total momentum score. Here is the drawdown as of the time this total momentum score was reached. And this last column, this is the number of days in which the total momentum score was negative before it got to 20%. Now, this is important because, as you can kind of tell here, the longer the longer it took to get to this point of total momentum being at negative 20%, the longer it took to get there, the worse the decline tends to be. So as you can see, in 2000, it took 19 days to get there. 2007 took 15 days to get there. 2022 took 14 days to get there. This one took nine days to get there. So just based off of this, if I had to guess, I would guess that there will be more of a drawdown from here, but it probably will not morph into a bear market of any significance.
2020 is very interesting to me there, being at 3. Because I just remember how fast it snapped back, so.
Right. And so so I have been kind of trying to draw that correlation, between like the faster the decline is, the faster the rebound is, and the less, well, 2020 was significant, but certainly the faster the decline, the faster the rebound. But, that wasn't the case in 2015. Late 2015 into 2016 was a, pretty tough period. 1990, took 13 days to get there. And at the beginning of 1990, that was not a significant decline. So, there's no holy grail, of course, but just based on this and, how I look at it, I would say that, chances are, we probably have not seen the bottom. But it's probably not going to be a decline of significance.
Yeah, that's interesting because I'm also looking at just recent, how many, there's 5 in the last 10-year period for us, but then I guess there's also 5. I'm trying to see if there's like any correlation over like each decade that you break it apart.
Yeah, and that kind of leads me to, well, let's look at this one. So I pulled up, in thinking about this conversation, a couple of charts from Carson Research. Ryan Dietrich, who's been a speaker at our NAIM conferences, gave a great webinar earlier this year. Well, I guess I'll go back to this one. So how often does a correction turn into a bear market? About 25% of the time. And then this one here. So the premise of this was the idea that typically there's a longer period of time between bear markets than where we are now if we were to have one, because bear market in 2022, if a bear market began this year, that'd be a pretty short period of time. The average and median period of time is 6 to 7 years. So that decreases the likelihood. I guess my only issue with this is that, as we talked about before we started, there's a definition of what a bear market is, right? That's a peak to trough decline of 20% or more. But especially in the recent years, we've had declines, 2018, 2011, August of 2011, August of 1998, August of 1990, those were declines of 18 to 19%. So those weren't insignificant. So,
And most of those were
they,
showing up on your momentum chart before, right? That you
yeah,
just mentioned.
yeah, 2018, 2015, 2011. 2015 didn't get quite that deep. 2015 was about 14%, before we found the bottom. Um, but yeah, I mean, so just to put it in perspective, if we defined a bear market as a 19% decline versus a 20% decline, by my count, we would have had 4 additional bear markets over the last 30 or 35 years.
Yeah, no, that's really interesting on just a percent on how much that makes a change there. What if you were to go down to 18? Then
Right.
what do you see?
And so that changes this slide, the percentage of corrections that turn into a bear market, significantly higher.
Do you know what that percentage is off the top?
No, because I don't have this is not every correction that's occurred in the past 35 years. Um, and I'm not sure how far back he's going with this data right here. Um, so now I don't know what that percentage is, but I mean, certainly be higher if you add another 4 bear markets in there.
So so kind of going back to it, he believes that we haven't had a long enough period to reach a bear market this year. Even though we can look back in here and see from 2020 to 2022. I mean,
I think he's saying that
looking
it
at
would
those
be,
numbers is there's a pretty significant variance between those.
yeah, I think this is just speaking to, the unlikelihood
Right.
of that happening. And, again, all I'm saying is that if we include 2018 in there and we include, 2011 in there, especially 2018, then we'd have 2018, 2020, 2022, and then potentially whatever this turns out to be. So, we could be looking at this, a slide like this, 3, 5, 10 years from now with a different thought process that, hey, this, it's not out of bounds for this to happen, every 2 to 3 years.
Well, then you also wonder, with how fast news travels, and there seems to, especially nowadays, be a lot of political influence headlines that can instill some fear into the market. Are we going to see these more rapid declines more often just based on that? Um,
Yeah.
I don't know, the speed traveling, the market conditions changing has always been like a big question of, are the markets still, is the fear and greed that builds its way into the market still the same as it was in the past versus the way that it is today, where we get information a lot faster?
Right.
I mean, you
Right.
see headlines change from like you look at nighttime, you wake up in the morning and it could be a completely different story from just
Yeah.
like going to sleep.
Yeah. Yeah. That's why I kind of, so when I look at, this here, I'm using data back to 1990, just because on most of the data services, I mean, that's where that's about as far back as you can get good, reliable intraday data. Um, but a lot of times I'll look at this and say, okay, because the decade of the 90s was, obviously, especially the late 90s, obviously, very, very strong years for the market. And so what does that look like, from 2000, right? For just, this century? Um, it does tend to look different.
Yeah, I know with our strategies, because we do a lot of NASDAQ 100, if we have the 90s in there,
But
and
yeah,
it
it wouldn't
backtest
even
it.
make sense.
Yeah, just you can see completely two different strategies from going back to the 90s and starting, maybe in like 2001 and so on. So, yeah.
Yeah, the Nasdaq 100 at that time was very much like it'd be like a biotech or like a semiconductor fund today. It was very exotic. Um, whereas now it's more of a broad representation of the market overall.
Yeah, it's definitely morphed and changed over the last, decade or so.
Yeah. So yeah, that's just kind of what I'm seeing, what I look at. Um, you know, Based on that, we did, take some um, take some money out of equities this week. Um, we could be right, probably wrong. Um, because again, the likelihood that even we look at this chart here, you know, even if we included those more significant or those, 18-19% declines, you're still looking at the majority of the time, a correction does not turn into a bear market.
Right, but
Yeah.
another thing would be how fast could you get back in too? Because I mean, going out and being able to get back in quick enough to, maybe catch the recovery, it might not be as significant.
Right. Right. So for getting back in, when we make a change to allocation, um, we don't make any adjustments to it, at least for that sleeve of the portfolio, if you will. We don't make any adjustments for at least 20 trading days, right? Because if not, then you could get whipsawed. When you're using a daily signal, I mean, you could get whipsawed. So um, so yeah, I mean, you'll have that as a, just kind of a little bit less exposure for at least 20 days, and then you can kind of assess where you are to see if you want to go ahead and get back in with whatever was taken off the table.
So is it always like a 20-day period?
For the daily signal, yes.
Okay.
Yeah. So I also look at, so that's not the full I guess that's not the full scope of the strategy. Um, I try to look at it in different time frames as well, right? So that's just kind of the daily scope, if that makes sense.
Okay.
But even from that standpoint, if we'll get a signal on a certain day and say, okay, we're not going to make any changes um, for 30 days. Excuse me, 20 days, 20 trading days.
So if you got a signal, let's just say to go to cash today, but then 2 days later it says, hey, no, let's get back in, you have to wait the additional 18 days to take that
Yeah,
new
I
signal
mean,
if it has that signal still?
so part of the confirmation is positive momentum for at least 20 days, right? And then the other part of it is that momentum score reaching a certain number,
Okay.
right?
Okay.
Because I could point to, uh, I'll show you in 2000, this drop that we had right here, um, that momentum score rebounded, within a number of days from that drop, that big drop that we had in, I think it was April. Yeah, I think that was the date, April 14th. Wasn't sure if it was that or the day before. But the score rebounded in a couple of days. Um, and obviously the market was choppy that whole year
Right.
until the significant decline began around October. So yeah, I just find that you can really get whipsawed if if you're trying to make daily adjustments. Um, based on anything. Now we could get more defensive inside of 20 days.
Okay. So
Yeah,
you can dial it back, but you won't add to it in that
exactly.
time frame. Okay.
Exactly.
Interesting. Yeah, that's just it's so different from what we do, and that's what I like about NAAIM. It's just everybody has a different process that they follow. We can follow the signals daily or the algorithms daily, depending on how they impact the overall system.
Mhm.
But you're right, there are times where, you can make a quick change and get whipsawed by the market, especially if that said algorithm, whatever it is bouncing around its trigger point. You end up in a choppy market. It's changing often.
Right. Right. I mean, case in point, today, we got this signal yesterday, and I don't know if I can go back to my chart of the S&P, but we saw what happened today. Now, do we go straight up from here? It's anybody's guess, but uh, let's see. Yeah, we got the S&P. So yeah, I mean, this again, for all I know, this could be about somebody else that says this. That I've kind of adopted this saying, the market doesn't really care what I think, um, or doesn't care about my analysis. It's going to do what it's going to do. But that's why, like I said, I think you got to have um, multiple. You got to look at the market from multiple time frames, multiple indicators, multiple perspectives. Um, there's no one signal that's infallible. Because if it were, then we would have found it by now, and everybody would use it, and then it wouldn't work anymore. Uh,
Right.
so, so yeah, this is just kind of, and what I actually did here is kind of pointed them out on the charts here with the arrows, so you can see there's 2022, is where the signal hit. You can see 2020, 2018. 2015, you can see I actually, didn't really get too much worse by the time that signal hit. But I think what's more important is that you can see we went a year like 2013 without getting that kind of a signal,
Mhm.
even though we had some dips like in June, I think in June of that year. We had a, nice little pullback there. There's 2011, but yeah, 2012, 2013, 2014, no signal was produced. There's 2010, 2007. Okay, and then we went from about 2000 to, or yeah, 2000, 2007 without really seeing it. There's 2000, and 99, 98, 94, and then of course we went 95, 96, 97 without a signal. And then there's 1990. So yeah, and that's as far back as I went with it. So
Yeah.
uh, So yeah, that's kind of what I'm seeing. That's kind of what I'm doing. This was just again kind of our first red flag to start to be a little bit more defensive. It's not the only thing, but in terms of like um, a daily trigger, that was it. We reached it. Um, you saw the canary in the coal mine. Looks like we had that kind of a signal there. So. Um, again, it's interesting to see, what other, I guess signals, if you will, that were kind of, initiated this week. And like I said, I'm a little surprised to see the exposure index that high. But I think a lot of that has to do with the leverage component and how it's actually reported.
Yeah, and I think it'll also be interesting as we, go forward the next few weeks, just with like name confidential and getting everybody's perspectives. Because last year, in a bull market, you're gonna have certain. I think you just learn a lot more about what we do over here at Name, a lot more in the bear market conditions. So
Yeah,
or if we're nearing that condition, so it'll be fun.
yeah,
Um, and I'm sure we'll have a lot of stuff to talk about at the UK conference coming up. Are you going to that?
yeah, yeah, absolutely.
Yeah.
I will be there.
Yeah. So what is it like? It's May 5th through 7th and out in
Yeah,
Costa
Costa
Mesa,
Mesa.
right? Yeah.
Yeah,
Oh yeah. I got to convince my wife to go out there. She hasn't gone to one of them yet, but has thought about it. I'm like, this is the one to go. You haven't been to California in a while, so
yeah,
come on down.
yeah. My family came with me to Orlando. Was it Orlando last year?
I think so.
Wherever we were.
Wait.
Yeah. So we were able to, we came down there and made a vacation out of it afterwards. Uh,
Oh yeah.
so that's always an idea.
No, it's nice that when you can kind of start off as a work trip, and then once you got all that knowledge from the name conference in, you need to digest it with something a little bit slower. You turn it into a vacation, family vacation, just
Yeah.
get the rest of it through. Yeah. You get so much at those conferences. I just remember all the time I just brought out my notes. I do this every year, um, from the previous conference about like a few months before the additional conference or the one coming up, and just kind of read through what did I write down. And it's
Mhm.
amazing how many things you don't remember. A lot of stuff on marketing, a lot of different AI um suggestions that people had from roundtables that we had in the conferences. So yeah, it's
Yeah.
fun. I suggest doing it because it's crazy how much you forget from
Yeah.
one year to the next.
Yeah. And for, members or anybody who's watching this considering membership, one of the real benefits of membership that I feel like we don't talk about it enough is the most of the presentations, if not all of them, you can go back and access in the member portal along with the white papers, and uh, lots of other good resources. So yeah, I frequently kind of go back to that. If there's something else, if there's something that I want to kind of look at or something, um, even a lot of the webinars.
Yeah.
I want to say, yeah, the webinars are archived there as well. So if you miss a webinar, yeah,
There was one on like emotional intelligence and investing and so on. I think it was maybe 2 years ago now. But I've been thinking about that one a lot lately because, you get another time period like now, clients start, hey, what's going on? What are you seeing? Oh, I heard about this. Are we getting out or, and I want to go back to that one and hear what he said because this is definitely very applicable in times like now.
yeah. I do have to say, I think in terms of um, how people are perceiving this market drop, I heard on the news, or somewhere, probably social media, yes, people are saying, not just any people, but like politicians are saying that, the stock market is crashing. You know, like I think, because of uh, what's going, everything going on right now, politically. There's, I grew up in and around the DC area and spent a large part of my life in Baltimore area. So, a lot of folks there, there's a lot of nervous energy in terms of, folks that have been um, laid off or have,
Mm.
um, job uncertainty. So I think there's a lot of uncertainty out there, overall. Um, of course, you look at inflation and things of that sort, and so I think the current market decline is kind of um, uh, magnified, if you will, by some of the other things that are going on. But to put it in context, again, it's a correction. Again, we all know on average we have a correction about once a year. Um, will this one get worse? Who knows? But right now, um, it's just a correction.
Yeah, I think my 2 cents is, when we get a little bit of certainty, we're going to see some decent few up days right there, and then once that's factored in, then I want to see where the market goes from there. So I do believe that there's just been so much uncertainty on what's going on, and it's just leading to more and more fear, and it just keeps building its way down throughout the public.
Yeah, yeah, yeah. Like I said, I think that has a lot to do with the perception
Mhm.
of how bad things are in the market. Um, so yeah. Um, One thing that's interesting, international stocks um, have not participated, to that extent in this decline. So um, I don't know if you have any international strategies or strategies that utilize um, international stocks.
We do not. I know I occasionally get papers from, I don't know, if somebody sends me a paper or a newsletter and I find it like relevant one time, I'll allow them to send it to me. And I know somebody had a section in there that was on international. They were talking about, I believe, England, last time I was in there. I don't entirely remember what they said because I don't pay that much attention to international stocks, but I
Yeah,
do remember them mentioning that it wasn't really participating, like you were saying.
yeah. So yes, it's interesting. Every market decline is different. Um, you know, in 2022, energy stocks were, kind of booming, as the market was going on. That's not really, it's not really happening this time. Um, yeah, I mean, they've held up better than tech, but uh, so yeah, I haven't explored too much in terms of sector rotation, in terms of, which sectors are really outperforming now. But um, I know healthcare has been stable. Um,
Maybe we'll
but
have to talk to Ryan. Doesn't Ryan do a lot of stuff with sector, or he has some sector rotation chart, if I remember right?
Yeah, he uses the relative rotation graphs.
Okay.
And
Oh,
I
okay.
think
Yeah.
I think Optima. Um, yeah, I think the Optima software is what has that relative rotation graph. The other thing that how much time we got, but the other thing that'll be interesting to see, and I don't have this one pulled up offhand, but there was a seasonality chart that discussed the fact that typically you see weakness. And I think it was looking at the, year one of a presidential cycle.
Mhm.
Typically you see weakness in this time period, kind of mid-February to mid-March. And this is kind of where the market tends to bottom, where we are today, kind of mid-March. So that's another thing. It'll be interesting to see how that plays out. Um,
Yeah. So I know, what was it? Jim Lee and Ryan were talking last week, a lot of seasonal stuff and how it's kind of trending back in to be a little bit better of a predictor than it was in the prior, like 4 or 5 years.
yeah, yeah.
So,
And, now with you know, there's funds that trade off of that. So it kind of becomes a self-fulfilling prophecy almost, I would think. The more money goes into it and the more it starts to factor in, then it just becomes a thing. So um,
till somebody feels like they need to reverse it or find a way to take advantage of that,
right,
that it works its way back and it goes in another cycle. So,
right. So yeah, I mean, it'll be interesting to see if that aspect plays out. Obviously we're still in a seasonal or seasonally bullish time of year, November through April. I think about that. Um, so yeah, have you looked at Season X, the software?
I am familiar with it. I haven't looked in depthly on it, but I do know what you're talking about.
Yeah, I think they did a webinar um, maybe a year or two ago. It was really interesting, really interesting.
I'm trying to think of who that would have been because that one sounds very familiar to me now. look back and realize I did the webinar now.
Yeah.
Well, looking at the time, I do want to kind of wrap it up here. Lots of great information, and I just think it's, each and every week that we got going on for at least the next month or two, it's probably a good time to zone in a little bit more to Name Confidential. We're gonna have a lot of bright minds here sharing the current state of the market and their thoughts. So once again, Greg, I want to thank you for coming on today and sharing all that. And we'll be catching up outside Name Confidential too.
Absolutely. Thanks for having me. Appreciate the time, and I will see you in